Monday morning. This is Dustin Hobbs with the California MBA. Welcome to Connect, our weekly podcast featuring one-on-one interviews and conversations with the mortgage industry's movers and shakers. We've got a great guest today. I'm really excited to chat with him about what's going on in the industry today. But before we get into that, let's thank our sponsors at Accelerate. Accelerate helps lenders close more loans through better borrower engagement as the mortgage industry's most innovative marketing and sales engagement platform. Accelerate CRM helps lenders manage workflow, contact strategies, lead management, referral, and realtor partners and reporting. Accelerate's engagement platform automates multi-channel marketing through social media, email, direct mail, text messages, ringless voicemail, and phone calls. It's all pre-built with strategies and content to enable better borrower engagement. Accelerate integrates with the software that's already powering your business today and into the future. In addition, the platform is SOC 2 and SSAE 18 certified to satisfy the most closely regulated businesses, and that includes banks with mortgage subsidiaries. So for more information or to see a demo, visit accelerate.com, or you can contact the company at the phone number listed in the description below. So before we jump into the conversation with our guest today, I want to toss it over to Susan Milazzo, our CEO, for this week's update.
Hi, this is Susan with the California MBA, here with your weekly video update. This week, we're talking about the Western Secondary Market Conference. And no, we can't be together in person this year, but we do have a very dynamic virtual conference platform that we are so proud to be offering you this year. We'll have some great content talking about what's happening in the capital markets, as well as some of the new challenges that 2020 has presented us. We're even working on a really fun entertainment surprise, but more on that in the coming weeks. I want to give a big thank you to our diamond level sponsors, AmeriHome, ArchMI, Flagstar, Mr. Cooper, and Western Alliance Bank. Thank you so much for your support for this year's conference, as well as all of our conference sponsors. You can visit our brand new website, cmba.com, click on the events tab for information on how you can register for this year's event and join us for the Western Secondary Market Conference 2020. That's it for this week, and we'll see you next time.
All right, thanks, Susan. And now for the main course of today's conversation. I'm really excited to have Doug Duncan, the SVP and Chief Economist at Fannie Mae, to join us today for the conversation. We've known Doug for a long time here at the California MBA. He's been one of the industry's most respected voices on the economy and on the mortgage industry in particular for a number of years. So I'm really excited to welcome him. So thanks for joining us, Doug.
Thanks, Dustin. Great to be with you again, virtually at least.
Virtually at least, right? So let's jump right into the questions here. So I'm curious. Let's start at the beginning. What's your background? What sort of led you up into the field of economics, and then how did you end up at Fannie Mae? I know you're at MBA prior, but what's sort of your path?
Well, I grew up on a dairy farm in Minnesota, and I knew I didn't want to milk cows for a living. So that was an incentive to do my homework. I did spend a little time in the Navy. When I was in the Navy, when the ship would be at sea, I've always been a reader, and for some reason I started reading Newsweek magazine. And every other week there would be a column by Paul Samuelson, and then the other week by Milton Friedman, who are two of the giants in the industry. Economics profession, and for some reason I got interested in that. I had no idea, there was no background to it or anything, but I thought these two guys, ultimately both Nobel Prize winners, and had very different views on how the economy worked. And I thought, well, if there's that much room for debate, I'm a Scotsman, I like a good debate, so I decided to become an economist. Having grown up in a farm, I actually went through the agricultural economics route, which is just the application of economic principles to agriculture. And finance was the part of it that I liked the best, going with my father to buy farm equipment and things like that, trying to understand all of that side of things. And so I went to North Dakota State for my bachelor's and master's, and Texas A&M for my doctorate. And then I came to Washington actually to network, to get more into financial services and away from the agriculture part. Ended up at Mortgage Bankers Association through a couple of different connections, and spent 15 years there, and then moved over to Fannie Mae in the middle of the crisis, which I think National Mortgage News did a headline, said, "Out of the frying pan into the fire." that was my move from MBA to Fannie Mae. So I'm not sure if I was a cause or an effect, but that's kind of how it happened.
Or casualty,
I've
yeah.
been there about
Yeah.
12 or 13 years now, so it's been great.
Yeah, well, that's great. Yeah, it's really curious. I love your background, especially on the agricultural side. I mean, I can't imagine you run into too many fellow economists that, that can point to, background and, like you said, going with your dad to go, buy tractor parts.
Yeah, the value of having grown up on the farm was really was very central in our vetting the post 2007 to 9 period and coming up with the explanation of the problem emerging being supply and lack of supply. So we were probably a couple of years ahead of the rest of the industry on that, and it simply came from the fact that every spring somebody would ask my father, Charlie, are you going to have a good crop of corn this year? And his answer was always the same. If you're going to have a good crop of corn in the fall, it depends on the tractor starting in March. And so it's a very practical view of a supply chain. So after the 2007 to 9 downturn, it was such a devastating downturn on housing. We started thinking about, well, what has happened to how you build houses and walk through the process of, well, first thing you have to have is a piece of land. And so we talked to land investors. Are you buying land? And the answer was no. And we're like, wow. If you're not even buying land, it probably takes 3 years to get land into development to even start building a house. That means another 3 years until we really see the production process gearing up. Well, demographics are compelling. People are born and grow, and that doesn't have anything to do with the housing supply chain. That's a separate factor. So we put those things together and we're like, oh my goodness, it's going to be a real challenge to rebuild the supply chain for housing. And if demand grows faster, you're going to see strong price appreciation for a long time period. And that's certainly what has happened.
Interesting. Oh, that's absolutely. You talk about a practical application of that background. So let's look at some macroeconomic trends right now. What would you say is sort of the biggest trend you're watching right now?
Well, in today's world, it's not about something economic. It's about the economic effects of a disease. So the first thing that we have to know in order to be able to refine a forecast is something even the medical specialists don't fully know yet, which is the incidence, severity, and duration of this disease. So those three things are what we really need to know, because they're the things that are generating fear in the minds of individuals and leading them to take actions which have been very hard on the economy, and policymakers also seeing that and making a response. So it's driven by things that I don't have an expertise in. So we're studying what the scientists are saying and trying to understand how that's going to impact people's behavior. So for example, yesterday when I spoke to our board of directors, I said one of the things that I think we want to be careful of in our language is people talking about a resurgence of the virus. There's a difference between its geographic movement, which I see is what's going on right now. It's not been a resurgence, it's that it has appeared in other geographies. It previously was not prevalent. That's one thing. But if there is a resurgence, that is, it recurs again in a place where it has been tamped down, that's actually, again, more destructive of economic activity. So that it's a nuance, but it's an important nuance. So that's the biggest thing that we're trying to understand today.
That makes sense. Well, so aside from the specific stuff to COVID-19, and I guess nothing can be separated from that right now. What would you say? What metric or rate would you say that mortgage bankers should be particularly focused on right now? Is it unemployment rates or interest rates, inflation rates, something else? I know mortgage rates are going to be fairly steady for a while now.
Yeah, so the first most important thing is a lesson that we learned in 2007 to 2009, which is if you're going to lend money to be repaid over a long time at fixed interest rates, it's a really good thing if the borrower has a job. So We've lost roughly 30 million jobs in the last 5 months or so, 4 months. That's historically unprecedented. On a percentage basis, it's similar to the Great Depression, but we lost it all of a sudden. It just went away, and that's going to take time to rebuild. Now, the thing that's different this time from 2007 to 2009 is that the jobs that were lost were primarily in businesses that are discretionary spending by middle and upper income households. So restaurants, hotels, airlines, sporting events, concerts, theater, that most of that is discretionary spend by higher income households, and it falls on the back of hourly wage earners primarily. Those hourly wage earners tend to be renters at a higher probability than homeowners. So to this point, actually the homeowning market has done very well relative to the rest of the economy, but the pressures are building on the rental side of things because the CARES Act and the $600 a week extra unemployment compensation runs out on the 31st of July. And that is one of the things that has helped renters stay current and also has helped support consumption from those lower income hourly wage jobs. Also, the PPP is the other piece that's supportive of the workers for small businesses, and then the access to credit for small businesses to keep them alive is also key. So mid-year here or in the third quarter, depending on what happens, if anything, congressionally and with the White House, we're going to get a test, and it will, in our view, start on the multifamily side and the rental side of the business. But if that again, and especially if it combines with an actual resurgence of the virus, that could lead to another shutdown and a lot more difficulty that could make its way over to the single family purchase side of the market, which to this point has performed quite well.
Yeah, it does make me curious, especially being in California here, where we were sort of locking down again. And then, doing this sort of in the, middle of summer here, knowing that coming fall and winter, we're going to have flu season again, and we may lock down again, either as a nation or, some of these states, like you mentioned, that have already locked down and maybe even have, in a sense, gone through the worst of the virus, like New York.
Right. Yeah, that will definitely be something to watch. On the we're trying to envision how that scenario plays out. For the time being, we've felt pretty good about our forecast on the home purchase side of the business, and that's a place where our monthly survey of households has been very helpful. So we observed initially the response to the virus was that everybody was concerned and worried about their jobs, which was a very valid concern. Then as it developed a little bit, we noticed that the share of people who said it was a bad time to sell was growing faster than the people who said it's a bad time to buy. So in other words, they were more depressed on the sell side than on the buy side. So how did we think about that? Well, if you had an existing home and were thinking about selling it, do you really want somebody that might be bringing the virus walking through your house? Or alternatively, you might think, well, if people are concerned about the virus, they're not going to be out shopping, so I'm not going to offer my house now and take a discount on the price. So again, that old story about supply came into play, because with interest rates at historically low levels, if you were in a salaried position and say a millennial, they are driving the demand curve, you might say, you know what, I'm ready to move out of the city, buy a suburban home, get away from the dense population areas, and interest rates are great, so now's the time to buy. So we said we think those two things are going to work together to support house price. There were lots of things about house prices might fall 5% or 10% or whatever, various estimates. We said we think it's actually the opposite. We think house prices are going to strengthen. The level of sales will be lower, no question about that. But we think in the process, supply will fall faster than demand, so price will actually increase. And that's exactly what has happened. So, you know, the 3 rules of forecasting: if you're going to give a number, don't give a date. Then if you're going to give a date, don't give a number. If you get it right, don't look surprised, right? So we got this one right, so we're not looking surprised. But our expectation for prices going forward, to your point about what happens next and what to watch, if there is this downturn, this second downturn in growth, then we expect house prices to flatten out. Not to fall precipitously, but to flatten out.
Okay, that makes sense. So let's switch gears a little bit here. I'm curious what your thought is on the current state of forbearance and how that's impacting the economy and the housing market in particular.
Well, it's been interesting to watch. There's, I think, somewhere between 8 and 9% of mortgage holders now that have requested forbearance. There actually were a number of people who took forbearance initially and have repaid it or brought themselves current and dropped the program. Those folks, we think it was probably an early precautionary move on their part because it was simple to do. And if you thought there was some risk you did not understand, but you thought there was some risk that might truncate your income or you might lose your job, better to take the precautionary move today and then watch what's going to happen. And when it becomes clear that you're not really at risk as you thought you were, then you become current again. So that has happened. But I believe that the share of people who are making payments on time while in forbearance is actually falling. So there is some view that, and the possibility is that if we see this second wave, but when I'm saying second wave, I'm meaning we're not renewing the $600 a week extra unemployment. Some of the PPP doesn't work. People get laid off. We may see some of this roll into extended forbearances and then ultimately into different kinds of modifications. So it's a work in progress. We've never had this type of a forbearance legislated and with the simplicity that's intended for the execution. But I think people in general, and I would say, have been a little surprised that there hasn't been a higher level of take up to this point than there has been.
Yeah. Well, and I'm curious, sort of following up on you referenced it, the extended unemployment benefits that run out at the end of the month, and the other benefits and relief that government's initiated that sort of ends this month here. Do you see, not getting into the politics of whether or not it should be done or should not be done, how much of an impact do you see that having on the housing market and the economy in general, whether or not it goes, it gets extended again or just not?
Well, there's 2 things to think about. One is if it is not extended, then what kinds of consumption are reduced? Because it's clearly supporting both consumption and debt reduction. There's been a big drop in credit card rollovers. It's clear that some households took the one-time stimulus payment and paid down credit cards. So the people are shoring up their balance sheet. That's a good thing. But it also means they're not consuming, which means demand for goods and services at businesses is lower, which leads to the possibility that they might lay off more people. So there's that side of the equation to look at. It's also the case that if that happens, then that could bleed over to laying off salaried people, and that would push some more people into the forbearance side of things. So it's a dynamic process, and whether if there is additional support, say for example, there's some discussion about 2 things that I'm aware of. One is not all the second increment of PPP funds were used. There's still a significant dollar volume outstanding. There's a discussion of how to redeploy that. And the second one is how to extend the unemployment insurance benefits without changing the incentive to work. So, for example, the National Bureau of Economic Research and the University of Chicago put out a study a couple of days ago that showed that in some of these job categories that we were talking about earlier, the unemployment benefit is greater than the income they had previously for 68% of those households. And for example, in the lowest quintile of that job group, the benefit was double what they were making previously. So the policymakers don't want to incent people not to go back to work. And I've actually talked to 2 or 3 small businesses here in the Cape Coral, Florida market where we live, and they've said that has been a problem for them, is recruiting people back because they're making more money on unemployment than they were when they were working. Sure. So those are some of the things that are going to be worked through, and some of the implications whether there is or is not an extension.
Sure, that makes sense. So back to the housing market specifically. I mean, obviously, mortgage rates, I should say, are extremely low and have been low for a while, and it seems like they're forecasted to be low for quite a while now. How long though do you see the current refi boom? That, I mean, every lender I've talked to in the past couple of months, I mean, they're having a great year, and a lot of it is due to refinance activity, obviously. So how much further do you see that going, knowing that obviously like you mentioned, the demand on the purchase side has been reduced to say the least, and refi has been sort of picking up the slack in the market right now?
Yeah, we've taken a look at outstanding mortgages, and it looks to us like about 60% of all the outstanding mortgages have a 1/2 percentage point or 50 basis point incentive range to refinance. So that's a big number. Yeah. So our forecast is that this year in 2020 we will see about $1.9 trillion of refinancing alone, and close to $1.3 trillion of purchases. Now that will run off going into next year. If you look at mortgage rates and the spreads of mortgage rates over the 10-year Treasury, which is the typical way that we think about mortgages, if you go back to April, that spread was about 263 basis points. It's now about 245 basis points, so it's dropped 20 basis points. That spread has narrowed, which has meant that since the 10-year Treasury has stayed pretty constant, the mortgage rate has come down. I think the most recent weekly measurement from Freddie Mac was it was right at about 3% for a 30-year fixed rate mortgage. But the 2019 spread average was about 180 basis points. So our expectation is that mortgage rates will still come down further as mortgage companies work through the volume of refinancing demand that's out there.
Gotcha. So last question I've got for you. Obviously, this was kind of big news in the GSE circles and the mortgage circles prior to everything COVID, and it seems like in some ways it's sort of gone on the back burner, I think, in a lot of people's minds. But not getting into again the politics of how it should happen or when, why, all that. But what are the steps needed for those maybe that aren't familiar with the process that needs to happen, or the steps along the way? What's needed for Fannie Mae to exit conservatorship? Because that seems like that's the direction everything is going. But maybe if we weren't completely aware of how that's going to happen, maybe you can give us the how.
Well, the administration has been very clear that that's an objective of theirs, is to release the GSEs from conservatorship in a safe and sound manner and privately capitalized. So that still remains their objective. One of the first things that has to happen for that to occur is there has to be a final capital rule issued, and that's forthcoming. Probably, I don't know exactly. FHFA is really in control of when that actually happens. But the reason that is a precursor to raising equity capital is that investors would have to have a basis to figure out what the return on capital will be in a private Fannie Mae or Freddie Mac. And so the regulatory rules that say how much capital is required for the companies based on the business that they're anticipating to do is a first and probably the most important key to making that happen. Then, of course, the Treasury owns 79.5% of the preferred stock, so there has to be a plan for how that is managed as the companies go private. So there's a whole series of steps, but really the first most important step is this capital rule.
Gotcha. Well, hey, Doug, really appreciate the conversation today. I think we covered a lot of ground. You know, my head is kind of full of data points now and information and you know, pointing me towards some news and some information we need to be all keeping our eye on. And so I really appreciate the talk, the conversation, and hopefully we'll see you here at a conference or an event, maybe in person next year at some point. And we'll really enjoy hearing from you again about the state of the industry.
That's great. Great to be with you. And yeah, I too look forward to a return to where we can be with people without fear, because it is where I think we're designed to be with people. So I look forward to that day.
Absolutely. Well, if you enjoyed this conversation, make sure and subscribe to our YouTube channel here. You can also listen to the podcast on Spotify, Apple Podcasts, and SoundCloud. And we'll be back again next Monday morning for another episode of Connect, and we'll see you then.